In 2008, the global economy faced its darkest hours since the Great Depression. Banks collapsed, stock markets tumbled, and millions of ordinary people lost their homes, jobs, and savings. But behind the headlines, behind the panic, lies a deeper story. A story of greed, ignorance, and hidden risks. Today we uncover the untold story of the 2008 financial crisis, the housing boom. In the early 2000s, the American dream was alive and booming. Owning a home wasn't just a dream, it was seen as a guaranteed investment. Banks encouraged people to take out mortgages, even when they couldn't truly afford them. Instead of carefully checking whether borrowers could pay back, banks were motivated by profit. The more loans they gave out, the more money they made. These risky loans were called subprime mortgages. Families with low income and poor credit history were suddenly being approved for large home loans. The logic was simple. Housing prices always go up. If someone couldn't pay, the bank could just sell the house for a higher price. It looked like a system that could never fail. But this belief turned out to be dangerously wrong. Wall Street's greed. Investment banks on Wall Street saw an opportunity. They bundled thousands of mortgages together and sold them as financial products called mortgage-backed securities. To investors, they looked safe. Credit rating agencies, trusted institutions, gave them high ratings, calling them AAA investments. But in reality, these securities were full of toxic, high-risk loans. Behind the shiny surface was a mountain of debt waiting to collapse. Hedge funds, pension funds, and even foreign governments poured billions into these products, not realizing they were buying financial time bombs. Wall Street greed didn't stop there. Banks also created something called credit default swaps, a form of insurance on these risky products. Companies like AIG, one of the largest insurers in the world, sold trillions worth of these swaps, believing the housing market could never fall. The bubble bursts. By 2006, cracks began to appear. Housing prices reached unsustainable levels. Families who had taken out risky loans realized they couldn't keep up with payments. By 2007, default rates skyrocketed. Homeowners started losing their houses. Neighborhoods were filled with foreclosure signs, and the once safe mortgage-backed securities lost value overnight. Investors panicked. Banks that had borrowed heavily to buy these products suddenly found themselves drowning in losses. The financial system, built on a fragile foundation of debt and speculation, began to unravel. The collapse of Lehman Brothers. The crisis reached its peak in September 2008. Lehman Brothers, one of the largest and oldest investment banks in the United States, declared bankruptcy. With over $600 billion in debt, it was the biggest corporate collapse in history. The fall of Lehman Brothers sent shockwaves across the globe. Stock markets crashed, credit froze. Banks stopped lending to each other because no one trusted anyone anymore. It was as if the heart of the global economy had suddenly stopped beating. Other financial giants like Bear Stearns, Merrill Lynch, and AIG also collapsed or needed government bailouts to survive. Trillions of dollars vanished from the global economy in a matter of weeks. The human cost. But behind the numbers were real people. Millions lost their jobs. Families lost their homes. Retirement savings disappeared. In the United States alone, more than 8 million jobs were lost between 2008 and 2009. In Europe, unemployment soared. Developing countries, reliant on global trade, also suffered as demand collapsed. The crisis didn't just damage wallets, it destroyed lives. People who once believed in the stability of the financial system realized how fragile it truly was. Government response. To prevent complete collapse, governments and central banks around the world stepped in. The U.S. Federal Reserve cut interest rates to near zero. The U.S. government launched a massive bailout program known as TARP, the Troubled Asset Relief Program, injecting hundreds of billions of dollars to rescue failing banks. In Europe, similar measures were taken to save the banking system. Central banks coordinated to pump liquidity into markets. Critics argue that governments were saving the banks, but not the people. While Wall Street was rescued, millions of ordinary citizens struggled for years to recover. The debate over these bailouts continues to this day. Lessons learned. The 2008 financial crisis exposed deep flaws in the global economic system. It showed how greed, lack of regulation, and blind faith in markets can destroy economies. New regulations like the Dodd-Frank Act in the US were introduced to prevent another crisis. Banks were forced to hold more capital and take fewer risks. But the question remains, have we truly learned our lesson? Today, we live in a world still shaped by the 2008 crash. Rising inequality, mistrust in institutions, and the explosion of alternative investments like cryptocurrencies all have roots in the financial chaos of that year. Conclusion. The 2008 crisis was not just about numbers on a screen or balance sheets in banks. It was a story of families losing everything, of governments forced into impossible choices, and of a global system that proved far more fragile than anyone imagined. The question we must all ask ourselves today is simple. Are we ready for the next crisis, or are we still living in the shadow of 2008? This was the untold story of the 2008 financial crisis,